Thank you all so much for joining, and thank you to the panelists as well for joining for this fascinating conversation. It's such an interesting time to be talking about real estate. We're coming off the back of a 3-4 year period where deal flow was lower, realized exits were lower, a bit of an anemic period. Deal volume plunged after 2021 and only really just started to pick up last year. So I'd love to kick things off with this idea of where exactly do we stand? Is a full rebound underway? Kathleen, I'd love to get your thoughts on that.
Well, you talked about the deal flow rebounding last year. I think that's really because we saw the 3 pillars of a real estate recovery coming into place. We talk about them as the 3 C's. So construction collapsing, cash flow growing, and capital returning. And if you look across each of these metrics, you look at our portfolio where we're concentrated in logistics and rental housing here in Europe and then in the US as well. Cash flow growth is high single digits in most places. Construction down nearly 2/3 from recent peaks, more in certain sectors like office. And then the return of capital has been really powerful. So when we look at the debt capital markets in the US, CMBS issuance is up 40% year over year. And that is driving the cost of capital down, even really ahead of rates coming down meaningfully as they have here in Europe. So our borrowing costs on kind of a benchmark CMBS issuance and logistics, that cost down 40% when we look at it versus recent peaks. So we see these pillars coming into place. And what that's meant is that you see transaction activity coming back, but it's still a really interesting entry point. When you look at real estate valuations versus really other asset classes, real estate values are about 5 or 6% off the bottom. And you compare that to the S&P, which is more like 90% from recent lows. So it feels like an attractive entry point for us, and we're trying to activate around that. In the last year, we've invested about $35 billion of capital. Last year, we did 3 take privates in the US, in the residential sector, also in retail, actually. And here in the UK, we've recently announced another warehouse transaction, warehouse REIT, another take private. And so really interesting things to do. And we're just trying to continue to put our clients' capital into the sectors like warehouses, rental housing, data centers, where they're benefiting from this interesting entry point, but also long-term tailwinds that will propel value into the future.
When it comes to the entry point, I'd actually like to get your thoughts, Isabelle, on that, because obviously you oversee a wide range of different asset classes at AXA. Do you see real estate being unique in that attribute, which Kathleen was just talking about?
No, but I agree that there is an entry point that is quite interesting on real estate. It's not all real estate, but maybe more Europe, more some asset classes. But when we look at where there is capital and capital available, the first asset class that comes out of everything is private credit. And it's just direct lending. It's everything that is asset-based lending, including real estate finance, real estate lending. So yeah, this year, that's the record high investment we've made on credit, and there's still capital available and a lot of business going there. The second one is infrastructure, because there's a lot of needs, and also because, yes, investors are under-allocated, where they generally have an allocation to real estate that can be, it depends on the balance sheet, but from 10 to 20% in infrastructure, they're generally below 5%, and so with very low allocation. So there's capital available for infrastructure and a lot of needs. And it's not just renewables or digital infrastructure, but it's also transportation. So it's a very wide range of products. But then, yes, I agree that on real estate, the entry point is quite good, probably more for Europe than the US if we start to talk about geographies, but and then private equity, because everybody is still waiting for the capital to come back on private equity. So across private asset, I would rank, yes, credit first, then infra, then real estate, and private equity.
And would you agree with that the European entry point is more attractive than the US one right now? Because Kathleen mentioned rate cuts. They did happen in Europe first before the US.
Yes, I think for sure in Europe, we've already moved a bit further when it comes to those rate cuts, and that makes it more attractive on a relative basis. Now, Europe, we also need to be aware it's a slightly lower growth economy, probably compared to the US, but I agree with the entry point. I think I'd like to pick up, in terms of good timing for the market, just that notion of income, and from that perspective where you're coming in, because we think to a certain extent right now you need to go back to the basics of real estate, right? For a while you could do this beta play, you could bet on, I don't know, logistics, do a levered beta strategy, and with that be quite successful. Now, in the market we're in today, we say uncertainty has become structural. It's not episodic anymore. It's a structural feature of the market. And with all that volatility going on, we actually think it's less likely to see quick yield compression the way we saw it after the last crisis. And what that means is two things. One, you need to go back to the basics and create alpha in the assets, so do asset selection and be active in your strategy. The other piece of it, we're seeking income. So income in real estate, you can now get in at attractive pricing just based on that income and income growth. And then there's some upside convexity if you do see that cap rate compression, but that really boosts your return versus 2-3 years ago, you needed to bet on that to get to your return. So that's another way of thinking why now is a good time to enter the market.
But I completely agree on income. But nevertheless, what is also very attractive, and it's true for real estate, but also infrastructure, is development. There is a lack of supply, as you said, lack of supply, notably on residential, but not just. Even if looking at the European market, the office market, start of new building have dropped massively, dramatically, and we see people coming back to the office. So there is no grade A building available, whether it's in London or in Paris. So building and rebuilding what is needed, what is expected and we can go across all asset classes within real estate. And it's also what we are doing in infrastructure. So developing platforms, it can be renewables. We are expanding notably with trains and for green transportation. So all this requires that you invest, you reinject, you build your platform. And it's a way, it combines the development margin, leveraging on the fact that there is a lack of supply, and also getting the income because, of the scarcity of all those assets.
Right. Sorry, go ahead.
And maybe just touching on that point of infrastructure meeting real estate, I think there's also kind of the crossroads, right? The way we think about real estate, since you said development and provision, I think there's also that social infrastructure.
Right.
So providing new residential space, affordable housing, senior living, student housing. These are pieces of real estate that have this infrastructure component. It's undersupplied. It has strong, stable cash flow.
Right.
But still, it's a real estate play to a certain extent. Data centers, quite similar, right? At least we say it's real estate going in for sure as you build it and put it all together, and then you can debate if it's infrastructure going out.
It's this blending of different asset classes and strategies. But it's interesting, this idea of where it belongs and if it's a different part of your portfolio than it used to be. Kathleen, if, as Annette says, if we are entering a period of more volatility and uncertainty, what does real estate become? Is it inflation protection? Is it income generation? Is it something entirely different?
Well, I think real estate can be all of those things. And if you look at rental housing in particular, one of the things that has made it so attractive for 100 years for institutional investors is the fact that your leases are really indexed toward inflation. They reset routinely. And it's been just a consistent, stable income generator. And I think for the reasons Annette and Isabelle have highlighted, we as a global investment community are finding platforms where, whether it's in rental housing or housing overall or digital infrastructure or the energy needed to really power the digitization of our world, there are investment opportunities in all these places because there has been underinvestment in them. So you're looking at housing in the US, we're 4 to 5 million units short of really what our country needs. I think here as well, you see significant gaps between demand and supply of housing of all forms. We're really happy to be able to be a solution provider to that. I think those problems are not going to get solved purely by governments or purely by philanthropy. You need to have private capital coming in even at affordable rent-regulated levels, and that's been a very successful strategy for us. At the other end of the spectrum, you have all of the ways the world is changing, and we're driving more compute, we're using more electricity for our homes and for our cars, and that is creating a potentially decades-long investment opportunity in data centers. We have $100 billion of investments across our firm. We share them between real estate and our infrastructure business. We've decided not to have to decide. Our investors who are in those strategies can participate in this. But it's really recognizing that there is exponential growth in demand for compute power. And we are really uniquely positioned because we have capital, we have expertise through companies we have bought and built, like QTS in the US and AirTrunk in Asia. And we have a lot of expertise in accessing and creating the power needed for those as well. And we continue to find that this is a really exciting sector where demand is outstripping kind of the ability to meet that in real time with supply. And so we feel like the fundamentals are very favorable for a long time.
I mean, the amount of capital going into it is remarkable. And Kathleen, if I could just follow up on one point on data centers, because it feels like every month there's a new person saying, oh, it's a bubble, it's gone too far. It was the Alibaba chair, I think last week it was David Einhorn. Is there any validity to that? That yes, it's promising, but maybe in some corners we've gone a little bit too far, especially in data centers of valuations?
Well, I'd say in real estate, you find bubbles where there is too much speculative supply for the demand to meet it. And that is not what we see happening in data centers. We are in constant communication with the largest hyperscalers, the most advanced technology users, and the word I used before, I'll say again, exponential increases in the demand they have for the compute we can help them deliver through a data center. I'd say additionally, data centers are not, at least in the way we do it, we're not building data centers speculatively. So we don't start building vertically until we have a long-term lease with a high credit tenant. And so again, that kind of negates the argument that a bubble could be forming. We don't have speculative supply. And I think what we're seeing happen is just the digital infrastructure commitments these users are making are multi-year plans so that they can continue to deliver on the growth for their businesses. So we remain really enthusiastic about the sector. And we're trying to find different ways.
I think on data centers, I completely agree. It's between infrastructure and real estate. We have made the decision to exit, to sell our data center platform. We have reinvested notably through credit. We have significant exposure. But I agree on the thesis, on the AI and so on. But at the end, you are in the hands. You can't build speculatively on data centers. The demand is there, but you are in the hands of a very limited number of off-takers. So this concentration for an end game that is not completely known, yes, create nevertheless some risk. The momentum is there. There is no need to, no way you can build speculatively just because of this demand. But at the end, yes, there is an end game that is a little bit unknown, and you are in the hands of a very limited number of players. So,
at the same time, I think it's important to be very specific about the strategy that you pursue to have a bit of that downside protection. So for us, definitely digital infrastructure is a key theme globally. Specifically in Europe, it's very much a hyperscaler game, similar to what you just said. I think differentiating between are you close to where the end user is? Because there, you have more of that backup, you have that continuous supply. Or do you go, for example, where power is cheap, which is a good play now, but once AI is educated, maybe there's more of a question mark. So I think it's also being very diligent about that, thinking about how is power transmitted. One thing is getting power. In Europe, it's even more about transmission of power and going where that grid capacity is, but equally staying close to the consumer.
I was going to ask how you're thinking about energy and data centers, because Europe is coming off the back of, I think you can reasonably say, an energy crisis where prices skyrocketed. With the amount of energy that these data centers need, is it a concern for Europe in trying to build this out and getting the power to back it?
I think power, it's more the power transmission that's really the challenge. There is a power challenge. There's also a getting the power to where you are. So the way we focus on it, yes, it may be a general challenge for Europe. How do you act on it? Going to those cities where you have upcoming grid capacity, whether that's Zurich or Milan or Madrid, and focusing on those where that risk can be reduced.
Yeah, with the last 10 minutes or so we have, I mean, these are really important areas of the economy, right? That people want exposure to, and this kind of gets into, should retail and wealth also get exposure to this, and can they get it just in public markets? Kathleen, as this conversation evolves, I know obviously you all are really large into this space and kind of one of the people really helping to push forward. Where does real estate belong in not just a wealth product, but potentially a retail product as well?
Well, I would say generally, my own view, and I think Blackstone's view, is that investors more broadly than just the institutional investor community should have access to high-quality managers of alternative investments, and that would include real estate and real estate credit and infrastructure. And if you think about the analogy of like my parents have pensions, one from a public school, one from a big corporation. Those are professionally managed, and therefore they have had access to the benefit of alternatives and the returns they've been able to generate, and with less volatility than the public markets. You instead look at my sisters who don't work at Blackstone and therefore haven't historically had access to this in their investment portfolios as they're saving for college and retirement. it's really trying to kind of open the aperture to say we can develop products that are appropriately designed for you. And we are really proud to have led the industry in developing a non-traded REIT that really represents the best of what we do. The asset selection that reflects our highest convictions, so rental housing, data centers, logistics, in the markets that are growing, in particular the Sun Belt of the US. And designing that in a strategy that has liquidity up to a limit. And I think we've now been cycle tested, and it has been a tough, couple of years for our sector, but to show that you can manage those and continue to deliver good returns. And we're really proud that our U.S. non-traded REIT has generated 9% returns since inception. That's a significant outperformance to the public markets. And we've been able to meet investors when they want their capital back. And so we feel really optimistic. And that experience, both in terms of the success of the investments, but also the success of the structure, is something we're now building out across our firm. When we look at private equity and private debt and infrastructure, we want more of this available to more people so that they can generate the kinds of returns that institutional investors have been able to generate for decades.
Yeah. I mean, Isabelle, you've been living through some of the changes happening in the sector. I mean, the fact we talked about this, that you were working for an insurer, now you're ostensibly working for a bank. There is more demand for these private capital platforms.
Yes, but we continue also to work for an insurance because we continue to manage the AXA capital. But being now part of BNP, yes, we have access to new source of capital. Of course, the insurance business of BNP Paribas, and also the wealth management. So yes, it's there. And I think the recipe to be successful, and it's not just for real estate, but infra or private equity or private debt, is really to create the alignment of interest between the institutional investors and the retail. So to give what you can deliver, the convictions, to really deploy those convictions also for wealth management. And within wealth management, you have a wide range of type of investor, from the more mass affluent to the ultra high net worths that are more like institutional investors. But it requires that you adapt the structure, the vehicles. You are operating in different jurisdiction, regulations that can influence the way you structure your investment. But at the end, what we pay attention to is really to deliver for those investors exactly the same strategy, the convictions that we have for institutional investors. And one asset class that works perfectly well is credit, notably, because credit, there is some embedded liquidity within credit. The cash flow is there, coming back every year, and you have your repayment at the end. So this is one of the very big focus we and we include real estate. We include real estate debt into those multi-credit strategies. So there is some real estate, not just real estate, but some real estate. And of course, yes, you can have some liquid. We have some liquid product dedicated to retail investors. But organizing the co-investment between the insurance balance sheet and those vehicles to guarantee the alignment.
Yeah, and I feel like PIMCO has been a little bit more reserved on this front. And obviously, PIMCO has a storied history with mutual funds and offering those types of products. How do you see whether real estate makes sense for this type of audience?
I mean, for sure, real estate makes sense for this type of audience as well. I think we all know it's a growing capital base, and therefore also an opportunity. I would maybe turn it around and say it's also important to make that capital available for some of the challenges and investments we need. So if we think about security infrastructure, for example, and a couple of other points mentioned earlier, we will need more capital flowing in these sort of investments, especially here in Europe, to be able to further develop that. And that's a great source which we should combine and leverage.
Okay. I think it would be good just to leave with an actionable item. So if an investor were to come to you and say they're considering adding more real estate to their allocation, what sort of principles would you leave them with?
Well, we always just focus on how do you position your capital in the assets and markets that are benefiting the most from just global megatrends and how businesses are operating and how people are living. So when you think about our portfolio globally, 75% concentrated in warehouses, which are benefiting from e-commerce, and now the additional booster of reindustrialization here in Europe and the US. Second would be rental housing. These I'd say, structural gaps between supply and demand, and the challenge of affordability in for-sale housing is making rental housing, particularly that's well-managed, really attractive across the spectrum of rent regulated all the way through to market rate. And the third thing I would say is like get indexed to the digital economy. Data centers are a great place to be positioned, because you're not having in that sector, if you're a data center investor, you're providing the platform. You're that essentially that infrastructure investor. You're not picking like which specific application within AI is going to be the winner. You win when you see the digitization of our world playing out, as we are all demanding, more information, more compute, more content as well.
Yeah, it's an interesting point, because just buying Oracle stock, for example, you're kind of taking a punt on Oracle versus the entire...
Participating in all of it.
Yeah.
Exactly.
Isabelle, what do you think? Sort of like leaving thoughts, if someone were to say, I want to have more real estate in my portfolio, what principles would you leave them with?
I would advocate for Europe because of the entry point and the adjustment of valuations we have seen. And I would also advocate for construction, because there is such a lack of good asset, grade A asset. It's true for offices, but also, we've discussed data centers, but residential. So development to rent or development to sell is definitely a strategy that we would push for, of course, being selective, but going across the various asset classes, and not ignoring offices, especially in cities like Paris or London.
And then, Annette, someone comes to you and says, I want that beautiful income generation, which you've been talking to me about. Where would you tell them to look?
So I would say, again, go for the global themes that drive things. Demographics, digitalization, decarbonization, deglobalization, defense, 5 Ds. So we're in kind of logistics, living, data centers as sectors that we think are interesting. And then go for infrastructure type investments that have the stable income, or for net leases, whether that's on logistics, could also be in retail in that case, where you get that income. And go for credit, actually, because we strongly believe in real estate credit, from lower risk senior lending on adjusted valuation basis to taking junior positions to fill liquidity gaps, which we still see in the market. So that's another big opportunity.
Anyone want to be brave with the last minute and say areas you think investors should avoid within real estate?
But I think it's not. I think we all agree on the trends and all those asset classes. But the reality is that it's how you deploy this capital. Because at the end, it's not just data centers, it's not just logistics, it's not just offices. It's where and how. So the local presence, the understanding of the local jurisdictions, and especially here in Europe, where we have different countries, different regulations. So understanding the local landscape, having the right connections, notably with public authorities, matters. So it's more the how at the end, because the big picture, I think we all agree on all those big themes. Right. But the way you are able to deploy the capital, the way you create the value, and your understanding of the specificity of the geographies matters.
Okay. Well, unfortunately, we're going to have to leave it there. I know we've only just scratched the surface. We could probably do this for hours, but thank you all for joining me. And please join me in thanking Isabelle, Annette, and Kathleen.